Hello everyone, good evening and welcome to The Money Show. Remember, this is the only show that will solve all of your questions on personal finance. We have top financial experts to help you answer all your financial queries. I'm Avan Dabat. Let's bring on board Pankaj Mathpal, who's MD, Optima Money Managers. He's going to be guiding us over the next 30 minutes. Thank you so much, Pankaj, for joining in. Now, before we get started with the viewer queries, there's some certain points that you want to bring a little bit more clarity on and explain to our viewers, and one that would assume importance as well. So when it comes to claiming deductions, everyone goes in a bit of a tizzy. Under Section 24B, you have some clarifications with respect to the interest home loan that can be claimed. What about the limits, and what about when there's two people involved regarding this?
See, when you pay interest on your home loan, you can claim deduction under Section 24B. And this limit is 2 lakh rupees for current financial year. See, earlier than this, you could claim on the self-occupied property, there was limit of 2 lakh, but on let-out property, there was no limit. But in this current financial year, in financial year 17-18, the total limit is 2 lakh rupees only, whether self-occupied or let-out property. But if the property in joint name and both the partners are paying EMI, they are contributing in the interest, in that case, both the partners are eligible to claim up to 2 lakh each. This deduction is allowed only from the year in which construction of the house is completed and possession is taken. So during construction period, when you pay interest during construction, that cannot be claimed during construction period, but once the construction is completed, you can claim that total interest paid is spread over 5 years from the year in which construction is completed. So suppose, for example, if you paid 2 lakh rupees interest during construction period, so every year 20% of that you can claim from the year the construction is completed. But again, the total limit will remain only 2 lakh.
Okay. So the total deduction cannot exceed 2 lakh in a financial year. Thanks very much for giving us that clarity. We've got a load of viewer queries, so let's get straight to it. And first, it's an email query which has been sent in to us, and this is from Mr. P.S. Subramaniam. He says, can you help with suggestions for my 35-year-old daughter's portfolio? Which funds should she hold on to and which funds should she exit? I also have an additional 10 to 12 lakh rupees to invest in mutual funds via an SIP for the next 10 to 15 years. So let's take a look as to which are the current stocks that he has in the portfolio as well. Some like Reliance Growth and Franklin India Blue Chip Fund. What would be your outlook on some of these funds, and what would you advise?
See, first thing, choice of scheme can be determined mainly by the factors like objective investment, risk appetite, or time horizon for the investment. So here, for a 35-year-old person, if you want to invest for long term, definitely you should have higher allocation in equity, which can give you better return in long term, because equity has potential to deliver better return compared to other asset classes. Now, as far as your current investment is concerned, your Reliance Growth Fund and Franklin India Blue Chip Fund, these are not performing well for quite some time. So I'll advise you to exit out of these schemes, and you can invest in some better performing scheme. And in your equity portfolio, around 60 to 70% allocation you should have in large cap and 30 to 40% in mid cap. So the good funds which I suggest you to invest can be like Birla Sun Life Pure Value Fund or Mirae Asset Emerging Blue Chip Fund or ICICI Prudential Mid Cap Fund. You can include these funds in your portfolio.
Okay, that's the view coming in. Some recommendations in the form of the Aditya Birla Sun Life Pure Value Fund, Mirae Asset Emerging Blue Chip Fund. That's the advice that you have in terms of individual funds as well that you can look to put your money into. But do remember that when you send us queries as well, give us a little bit of an understanding as to what the objective is of your investment. Let's move right on then and get in an email query. This has been sent in to us from Mr. S. Roopchand. He says, should a retired investor 59 years age at a 20% tax bracket opt for a dividend option or a growth option while investing in debt funds, including liquid funds and equity funds and balance funds? So just give us a little clarity first up as to what tax bracket would be, whether or not the dividend option or the growth option would be more preferable. Can you explain to us first, Pankaj, what exactly these options would mean, and then what do you think Mr. Roopchand should do?
Yeah. See, under dividend option, you get dividend periodically. So whenever this your NAV appreciates, you may get dividend on that. In growth option, there is only capital appreciation. Now, decision is based on some factors, like for non-equity fund, means debt fund, liquid fund, or any fund which has equity allocation less than 65%. In that, when you get dividend, there is dividend distribution tax applicable at 28.84%. It is adjusted in the NAV itself. So, if you are in a lower tax bracket, say for example, you are in 5% tax bracket or 20% tax bracket, it is better to opt for growth option because you are paying lesser tax, and especially when you are thinking about the short term. In long term, because in long term the tax, long term capital gain tax is 20% with index. So, in that case also it is better that you go for growth option only. Now, for equity fund, because there is no dividend distribution tax applicable, so there the decision may depend on the need. If you need liquidity, you want periodical returns, in that case you can opt for dividend option, otherwise growth is a better option for you.
Okay, and you know, sometimes Pankaj, what tends to happen is that in order to save on tax, a lot of people opt for a fund, you know, without really going into the details, with only the pure end attempt to try and save on tax, and then, you know, they fall prey to the first salesman that comes along, or they fall prey to a lot of hasty decisions. Any ground rules, any, you know, thumb rule advice really as to how one could avoid this?
See, if you are referring to like deduction under section 80C of Income Tax Act, because that is the first thing when people think about investment, they think about investing in such a way that they invest as well as they save tax. Now, here you have many choices. If you want to invest in a debt category of investment, you have choice like NSC in post office, or term deposit, or fixed deposit of 5 year, or PPF kind of things. Then if you want to save, if you want to invest for protection, like you have insurance policies, you invest in that and also you get tax benefit. Then coming to growth, when you want to accumulate money for your goals, you have choice to invest in ELSS, equity linked saving scheme, which is one kind of scheme in mutual funds. So first you have to decide that what is your objective of investment, what is your risk appetite, what is time horizon. If you want to accumulate money, if your objective is to accumulate some corpus for your future goals, then ELSS can be a better choice, because one thing, it has potential to deliver good returns. Lock-in is only for 3 years, returns are tax free, and if you opt for dividend also, dividend is tax free, as well as capital appreciation is tax free. So, if you want to invest for achieving some goals in long term and want to get expecting better returns with little bit higher risk, then ELSS can be a better choice.
Yes, everyone who has a taxable income should look to invest in ELSS. Can you just also give us a few more details on, you know, the kind of allocation one should have in ELSS, and, you know, what exactly that should be in the total portfolio?
See, if you are investing only 1,50,000 rupees, then definitely you should have allocation between debt as well as equity. And in debt category, my preference will be like PPF, because it is tax free, returns are tax free compared to your NSC or fixed deposit. So, PPF can be one choice. If you have girl child in your family, then you can consider investing in Sukanya Samriddhi scheme. There also returns are tax free and you get benefit under section 80C of Income Tax Act. Now, coming to your allocation equity, ELSS is the best choice, because most of people, they invest in insurance policy which neither has potential to deliver good returns, nor that kind of policy which invest in, which has the combination of investment and insurance. They serve the purpose of insurance. So, when you think about insurance, buy only term insurance policies, and for investment, either you go for this, like I told you, Sukanya Samriddhi scheme or PPF kind of products in debt category, or in equity, ELSS is the best choice.
All right. So, without a doubt, when you're looking to save tax via mutual funds, ELSS would be your preferred option. And you also had, Pankaj give us some of the names as well that you can look at. But just talking about, the previous query that we got from Mr. Subramaniam, investing in mutual funds via the SIP for a long-term time horizon of the next 10 to 15 years is what he was saying. And this is a topic that we tend to discuss with our experts fairly often. Can you give us a sense of when it comes to the ideal portfolio allocation, how much should be, in balance funds, in debt funds, in large cap funds, mid cap? What would be your ideal advice?
See, your allocation, equity and debt depends on the objective of investment, time horizon, risk appetite, many factors.
Sure.
But as a rule of thumb, if you don't consider any of these or don't have much information, then we say 100 minus your age should be your allocation in equity. In that way, you can invest. Otherwise, mostly it depends, because sometime a person with higher age may have higher risk appetite, or a person with a younger age may not have that much risk appetite. So, it depends on an individual. But yes, you must have allocation in different asset classes, because equity has potential to deliver higher returns, but debt gives you stability to your portfolio. So, you must have allocation in both the asset classes. In long term, when you are investing for long term, like for child education goal, their marriage or retirement, etc., you must have higher allocation, say 60-70% in equity or 30-40% in debt oriented mutual funds or in direct debt investment schemes. Now, coming to within that, if you talk about the equity, in equity also, because there are different kind of schemes like large cap, mid cap, small cap, sector fund, etc. So, people first thing should, especially investor who do not have much knowledge of equity market, should stick to diversified equity mutual fund schemes. And in diversified equity oriented mutual fund schemes, say 60-65% allocation should be in large cap, 30-35%, 40% allocation can be in mid cap schemes. Sector funds are specifically for those investors who know the entry and exit time, because this sector fund may outperform the broader market during a specific period, but in long term, definitely diversified equity funds will be a better choice. So, based on that, if you are investing for long term, your equity allocation should be higher, and within that also you should have allocation between large cap as well as mid cap funds. As far as balance funds are concerned, suppose you are investing through SIP route and you want to invest a smaller amount. In that case, instead of going into small cap, mid cap, large cap, you invest in a balanced fund, because any balanced fund that has allocation typically 65% in equity and 35% in debt. So, in that case, it is a good choice that you go with a balanced fund. Suppose you are investing 2000 rupees, 5000 rupees per month, and you want to invest only in one scheme. So, balanced fund can be one choice for you.
All right. I hope you've taken note of all of that advice. Very important to know the overall allocation, how much should be in individual mutual funds. 100 minus the age should be the allocation to equity, says Mr. Mathpal, in terms of a rule of thumb. But of course, the objectives should be very well understood. Tell you what, we'll slip into a quick break right here on the show. And for all of you who are watching, I'm sure you have lots of questions and queries to ask our experts. Please do reach out and we would love to help you out. You can email us on the Money Show at etnow.tv, connect with us on facebook.com/etnow, simply tweet to us on @etnowlive, or pick up the phone and dial into 022-2483-7111 and send in your questions for the Money Show. We've discussed, the dividend versus the growth option. We've also spoken about, the correct mutual funds that one should have and the right allocation. Now we have a live caller connecting with us. We have Shyam Karani with two questions. Shyam, thank you for being with us today on the show. Tell us, what is your first question that you have?
Yeah, first of all, let me compliment you on anchoring the show. You do a wonderful job.
Thank you so much.
The Money Show is really great.
Thank you so much. So nice to hear that.
Boss, I'm 59 years old. I'm also in the 20% tax bracket.
Right.
I'm actually retired, but not crossed the senior citizen boundary line of 60 years. I wanted to invest for short term in either a liquid fund or in an arbitrage fund, which will be more beneficial to me from the taxation point of view, and which is more convenient to access on a quick basis. And should I opt for the dividend option or for the growth option in this case again?
Okay.
And should
you
I
know
have the
what?
second
Let's get this query answered, Mr. Karani. We'll answer this and then we'll talk to you about your second query. So first, let's understand as well, what is the implication of a liquid fund versus an arbitrage fund, which would be the more convenient option?
See, convenience, if you see, then definitely liquid fund, because you have faster liquidity in this. If you want to redeem anytime, just next day you get money in your account. And arbitrage is a T+3, so the day you want to redeem, third day you get money in your account. So that way, definitely liquid fund has higher liquidity. But if you talk about that from the tax planning perspective, see, this arbitrage fund have taxation similar to equity fund. So in that case, in short term, there is only 15.45% tax, and in debt fund, liquid fund, it is added to your income. As you said, you are in 20% tax bracket. So in liquid fund, on the whatever profit you earn on the capital, short term capital gain, you will have to pay 20% tax in short term. So in that case, definitely arbitrage fund scores over liquid fund in your case. And as far returns are concerned, arbitrage fund is a different kind of fund, which like arbitrage in the market means buying in one market, selling another market in equity stocks or equity derivatives. So here returns wise, if you think, it may be almost same only as a liquid fund, but if you consider post tax returns, this arbitrage fund will be better choice.
Okay, I hope you've taken note of that advice in terms of what you should opt for. An arbitrage fund would be better. So tell us, what is the next question that you have for us, Mr. Karani?
Sorry, one follow-up is there. Should I opt for the dividend option or the growth option in an arbitrage fund?
Yes, that's what you had asked earlier, and that's a similar question that we got from Mr. Rupchand as well. What's your advice, Pankaj?
If you are going for arbitrage, you can go for dividend option.
Okay, versus the growth option, dividend works better if you do opt for the arbitrage fund. Go ahead then, Mr. Karani. How can we help you with your next query?
Yeah, thank you. I'm in February, I'm going to be 60 years old. I wanted to ask you whether it is advisable to invest in senior citizens savings scheme, which is the SCSS, or invest in mutual fund. I'm trying to collect some money so that I can invest in the senior citizen scheme. Since I'm the 20% tax bracket, and actually I think perhaps if this additional money which I will earn from the senior citizen scheme, that may raise my tax bracket to perhaps the 30% tax bracket. So what do you suggest? Should I invest in SCSS or should I put in mutual funds in the growth option or something?
Okay. You know, we have in fact received questions like this in the past as well, whether or not it is advisable to look at the senior citizen scheme. Give us an insight, because, you know, he's been fairly clear, Pankaj, with what his goals are for the long haul, looking to save up. Is it a blind answer that, you know, the mutual funds would be a better option? I'm curious to know what you have to say.
I'll say you should invest in both, because definitely in mutual fund there are MIP kind of scheme. Though there is no guarantee of monthly income, but they allocate money in equity and debt, and little bit allocation in equity, more in debt. So that can be one choice. But yes, the senior citizen saving scheme, because there is guaranteed returns, though returns means these are revised time to time, but still, because these are from the government, and you can more trust on that kind of schemes. And whereas these mutual funds are concerned, this depends on the performance of the underlying assets, but there is higher growth potential. There are chances of getting higher returns with MIP compared to your senior citizen saving scheme. So I'll say that you should allocate your money in both the things, and otherwise also there is a limit of investing in senior citizen saving scheme to 15 lakh only. So invest in senior citizen saving scheme and balance you invest in MIP.
You know, but I just want to ask that there are certain problems as well when it comes to the senior citizen savings scheme, the income from the scheme being subject to TDS, etc. So how would an investor deal with that?
No, definitely. See, amount is taxable. TDS is one thing, and second, TDS is only at 10%, but you have to pay tax. If he's saying he may be in 30% tax bracket, it means he has to pay balance 20% also. So 30% tax. So post-tax returns will be definitely lower. But when sometime, whole money investing only in assets which do not offer you guaranteed returns may also be a bit riskier. So for senior citizens who are retired, they must invest they must have some allocation where they get a fixed income, because in senior citizen savings scheme he will receive quarterly interest that is guaranteed. In monthly income plan of mutual fund, though they try to give you dividend periodically, but there is no guarantee how much dividend is offered. So in that case, that's why I said that you should have allocation both. MIP kind of products can give you better returns without any guarantee, but this senior citizen savings scheme will offer you guaranteed returns, though returns will be much lower post-tax.
Okay, thanks very much for connecting with us. I hope we were able to answer both of the questions that you had for us, Mr. Karani, and pleasure having you with us today on the show. So thank you so much, Pankaj, for joining in and guiding us with those views and the spontaneous queries as well that we got. And as we wrap it up on The Money Show, I want to reach out to our viewers saying that I'm sure you have questions or queries. We run tax, insurance, mutual funds. Please do reach out to us and send in your questions and queries. You can simply dial into 022-248-37111. The best way would be to shoot us an email on themoneyshow@etnow.tv with all your details.